Is the conversation going to continue? Do you see there being a sort of logical extension of what was discussed there in Portugal a few weeks back? And of course, Janet Yellen was not a participant there. This is the first time you have these two central bankers together.
Yeah, sure. So, I mean, our sense of what was said a couple of months ago was in particular Draghi, that that the economy is doing relatively well. Our game plan is to taper over 2018, and that that unless something strange happens, that's what we will do. So I think that message is one that they will try and hold to. And the truth of the matter is, obviously tapering and these kind of actions, changing the shape of the central bank balance sheet is a relatively new policy tool. And I think the one thing we've learned, certainly relative to the May 2013 event, is that policymakers are keen to ensure that they don't create unnecessary volatility as they start to change the shape of the balance sheet.
Yeah, Mike, I'm glad you bring that up. Given the newness of the terrain here, what can Mario Draghi and the Governing Council learn from the fabled taper tantrum that we had here in the U.S. a while back?
I think the most important lesson out of that is getting the market set up for it is a good idea, and a drip feed of information is the best way to prevent a big sharp market move. And I think that's what you've seen certainly with the ECB over the last few months, and in truth you've seen that with the Fed actually in this whole tightening cycle. I think there is a recognition, and we would agree to this, that that there is still a high level of gross leverage in the global economy. So slow tightening as you move out of an emergency rate seems like a good idea to us.
Mike, what is the best bet you have right now in the market? Is there something, I don't know if it's a distortion that you want to play, or is there something that just looks attractive? Yeah,
well, I mean, I guess perversely in the context of the debt ceiling debate, there is there's an argument. We actually think that U.S. Treasuries, certainly on a relative basis, I'm a bond guy, so on a relative basis, look pretty good. A lot of risk assets have done very well. So we like the relative value of Treasuries versus other things, in large part because we've seen part of a rate cycle there, and they give you some two-way risk. 220 on a 10-year Treasury note can go either way. 35 basis points on a bund, 1% on a gilt, and 0 on a 10-year JGB is a bit more hard to see a big rally.